All right, so I think the misconception from the last broadcast that we discussed was about the option strategy. And I know I got a bunch of messages, Justin, I don't like doing spreads because it caps off my upside. But okay, I'll accept that premise. But depending on how you're playing it, what if you don't get your move right away, right? So I think the best way to hedge that, there's two ways. One is size. You could always do less. Let's just say we're playing calls, for example. So let's say you're normally doing a 10 lot. If you don't want to do it as a spread, maybe do a 5 lot. Or if you do the 10 lot, and let's say you don't get your move right away, maybe convert half of it into a spread or maybe the whole thing into a spread. So, for example, let's just pull one up. NVIDIA is a big popular stock these days, right? That's actually one I have a trade in and actually did some adjustments on today. But let's say, for example, we went out to let's say the November contract. And, for example, you bought the 145 calls, so they're $4.45. And initially, my play there was to sell the 155s against it. So I actually took in about 60-something cents here with time decay. And the trade, I think at the time, I also sold the 135, 130 put spread to help fund it. And initially, I think I paid $2 for it. I had originally done the trade for $1.70. I got stopped out. I triggered again. I put it back on. And here we have a little bit of stagnation. So what I decided to do was to take that 155 and roll it down to 150. So I pocketed the 60, I think it was like 66 or 67 cents. So a trade that went from $2 now is obviously cheaper. It's like $1.40 or $1.35. So yeah, I mean, maybe I won't make as much money, but I just want to stack up winners, right? I think a lot of people make that mistake that they're looking for the full extension or the full articulation all the time. Now, what I'll often do is I'll start off looking for the bigger move, right? Maybe I'll only do the calls, or maybe I'll do a wider call spread, on the downside, the same thing. I could buy puts or buy put spreads, but I like to use it to help me with time decay and just if I'm outright wrong, right, on direction, which can happen. It's also very difficult sometimes to get both time and direction correctly at the same time, particularly if you're in weekly options. And that's one of the reasons I don't like weekly options. I'd rather pay a little bit more and go out further than have to have my move right away and get banged out by some kind of headline or something that delays the move or just doesn't make the trade work. And I like to sometimes give it some time to work. Another, I think, big misconception here, and I was actually reading an article this week and from, I forget who published it, a trader. And they were talking about how when they put on options plays, they know that their risk there is, for it to go to zero. I'll accept that premise, but what I won't accept is that you have to let it get to zero. So what people often ask me, all right, I'm good with trading in shares and setting stop losses. How do I do it with options? So there are two methods that I've used for this in the past, and one I prefer over the other. So the first one, which is my least preference, is just set a percentage that you're willing to lose on the trade and just cap it off there. The other way, which to me is the, I think, better method, is set an alert on your chart for the stock price, which you believe would invalidate the trade. And as you would stop out of shares, just stop out of the options trade. You can do that or make the adjustment. I'm cool with either one of those. But if for any moment in a trade, you feel that your initial reason for getting into the trade is no longer valid, it's time to go. I've often seen people say, okay, I'm going to enter this as a trade, but I'm going to take it, as an investment at this point because it didn't work right away and I want to give it more time. So my answer to that is the only circumstance that makes sense is if it's going your way and you think you can make more out of it. So in, let's say our example here with the NVIDIA options, let's say it started kiting on up. How would I play that to do the add? So there's two ways you could do it. One is you could buy a still higher strike call, or you could just add to the existing position. The other way, and this is sometimes the more dangerous way, but one I often like, is roll up the put spread or roll up the puts. So in this example, I was short the 135, 130, I could roll that up to 140, 135, or 145, 140, or 140, 130, just depending on how much delta risk I want to take on at that point. So that to me is a better strategy, and I never want to let those options go to zero. I mean, once in a while you'll get blindsided, right, by some news, and it'll take things down, and you just get washed out. And of course, it is good to have that defined risk situation. But for me, over the last few years, more in particularly, I've gotten more into doing spreads. I understand it caps off the upside risk, but it also minimizes my downside and helps me have a higher percentage of winners than I would necessarily if I only played the naked side of the trade. And I hear from a lot of people, I get a lot of messages, and often they're like, oh, Justin, I made this amount of money on this trade, it worked out really well. But then I'll hear, I'd put on this trade and I didn't make as much money as I thought I should have. The market was down a lot and we got a rebound, and the stock went my direction, but I didn't make it so much on the call premium. And they often ask me why. So I say the answer is the volatility component. It was too high at the time. And yes, you got your direction right, but you got crushed in your Vega. So a lot of traders, I don't think, understand that concept. But say you have a VIX up at 30 or 40 or whatever, and then the VIX gets cut in half. You have a certain component of that options pricing that is volatility. So what's the best way to counteract that? Spreads. Because you're not going to get the 1-to-1 ratio, but you will get a significant enough amount that it could still make the trade a winner for that rebound. And I think that's where a lot of people go wrong. The other way that I like to do it is, let's say I'm just buying shares down. I could sell an upside call, which is juiced, and then the volatility component can crush on that. And then there's also the time decay, right? Theta burn. Another method, and this is, I guess this is a little bit more advanced kung fu here in options, is I'll sometimes do what's known as a synthetic butterfly. So let's just make it super simple for this example. Let's say I have 100 shares of XYZ or NVIDIA, for example. All right, we're using NVIDIA. We say we have 100 shares of NVIDIA. And I'll say, okay, I want to hedge that out a little bit. Let me sell the 140. Well, I guess the 145 is probably a little bit tight, but let's say I went out to December this time. I think that people are going to hold NVIDIA because they don't want to take the tax hit, and they're going to hold it through the end of the year. And I'll say, all right, I look up at the channel high, I see it's around 150. How far past that do I think it can go? Maybe 155, 160. So I can go in there initially. Let's say I sell the 155 call against it. So now I have that hedge, that premium, and let's say NVIDIA starts kiting up, right? If we get past that point, or we get close to that point, but I want to put on some extra juice, I can buy a still higher call strike. Yes, I won't get as much of the gain, but at least I'll be participating more in that. Another one here, if you want to juice your returns and you want to, I guess, minimize your risk, and this is one of my favorite ones. It's often called share repair, but it can also be share enhancement ideally. So let's say the share repair is, let's say you're in something and the stock is down and you didn't stop out, which you should have. You can often use that shares you own to cover an overbuy in calls. So what I'll do, the example with the 100, is I have my 100 shares. I buy the 140s. Let me see how I can structure. I'm actually going to structure this for you guys. So let's say I bought in November. Let's go. So this would be enhancement though, because obviously NVIDIA is not down. So let's say I bought the 145 calls and I have 100 shares. So what I'm going to do is sell 2 calls on the upside to pay for the entire trade. So I have to now go in and figure out what I can sell to do that. So you go in the options trade and you create it to custom. And if I do 145, 150, I can get an 80-cent credit. If I juice that up, I want to see my ideal scenario there is where can I put that on where I'm either getting a tiny little small credit or it's zero, right? So in this example, in November, there's no real juice. I don't know that I'd put it on for just $5, but you could. In this instance, it would be that 145, 150. But let's say I wanted to play it for a little bit more, and I go into December, I buy the 145s and I'll start off high. Let's say I want to sell 160. I think I can fill that probably for about what I'm looking for. Yeah, here we go, 15-cent credit. So you have a $15 wide call spread now, and your shares that you're overwritten on, so we're in this instance long 1 times the 145, short 2 times the 160. We have now paid for the entire trade by the override of the calls, and you've now doubled up your share price, right? Your quantity. So instead of 100 shares, you're now playing with 100 shares plus a call covered by the short 2 calls on the upside. And the same thing, if it starts running and kiting up and you feel like you're getting capped out, you could always buy a still higher call. The one thing that I caution on this, and sometimes I don't like to do covered call strategies or this strategy, is that if you get your move too quickly, and you want to just exit it, right? You want to just book the profits. You can't always exit it as cleanly and as nicely as possible. And I think sometimes people will get caught up in the fact that they have the premium written and not take the gain. So over time, my experience has been, if you get the move you're looking for, no matter how fast it happens, just book it. Particularly if it's quickly, because what'll often happen is you'll get your move you're looking for quickly, and then by the end of the expiration, the trade is against you. Often it'll just keep going and it'll blow through, and you get a little frustrated that you could have made more, but that, in my view, is a high quality problem. So that's my from my experience. I don't know what the actual quantifiable data is on that, but from my experience in actual trading and practicality, that to me is what works. I'm trying to see if there are any questions. I feel like the chat might have not been enabled properly, because usually you guys are typing something in here by now. No questions? No comments? Could someone just type something so I can see if the chat's working? I'm assuming it's not working, because usually you guys have stuff to say in here. Again, I guess I screwed that up when I set this up. We'll get it 100% of the time at some point. One of the things I'm watching here also, the market today is one of those days, right, where you would benefit from short premium here because of the time decay. And in our example here with NVIDIA, if you were in the December options on the 145s, you have 12 cents of decay in your long strike, but you'd have 10 cents of decay in your short strike. So it helps eat up a lot of that. I see. Okay, so it is working. That's fantastic. I want to talk about AMD. We can do that quickly, and then I want to talk to you about what I'm seeing as potential problems. So AMD, I don't love this. They're going to report here on the 29th. I don't really see that clean of an edge on this, but if I were... it's still within an uptrend and a bit of an up channel here, but it is below your 200 MA, which I think it needs to clear for the Mobros at this point. And for me, the must hold is the 50 MA here at 155.27. So I'm not sure how you're structured in that trade, but I don't really see that clean of an edge here, other than the fact that it broke trend, checked back to the bottom side of, or the underside of it now on multiple occasions, and this one's still lower. I usually would be more comfortable. It's sort of riding it down here, right? But now it's starting to perk up. I do like that there's a higher low with a potential secure low here, but for me to add to the position, you need to clear that 200 MA at 163.03, and to stay long, you got to hold the 155.27. So that's my take. TLT is something I'm paying very close attention to, because now I see the 10-year is up over 4.25%. And I think that's what's delaying the market here. I think bulls want to run, but they're having problems with interest rates. And the TLT now made a new fresh low for this leg. It's got to hold here at 91.47. If not, I think we're coming down to 90 and maybe even 88s again. My thought here also is that if we can stay over, and I realize the TLT is the 20-year bond, but it's the closest thing in my view for trading purposes. But if I'm looking here at the 10-year, anything over 4.25, I think risks a move up to 4.5. And I don't think necessarily equities are going to love that. So I think that could be a bit of a fly in the ointment. That also, and if the dollar really got ripping to the upside, we're in a state or a stasis of the dollar here where we're coming up against that key pass don't pass line for me, which was the old 104.636 to 105.01. And I think that there is room to go a little bit into 105s, but if they start accepting, I think it's bad. And I would only feel better on the dollar. Number one, back below the 200 MA at 103.786, and more importantly, below what I viewed as a breakdown that we saw on 718, that 103.65. So below there, I'd feel much better that the dollar is like chillaxed. Oil obviously is taking a hit today on a couple of things. One is that the Israeli counterstrike on Iran did not target oil facilities and apparently not the nuclear program. So I do think that this ratchets things up a little bit, but I don't think it ratchets it to the point of oil spiking. But I also think it could be signaling slower growth. I think this week, if I'm not mistaken, I just want to confirm this before I actually say it on the stream, but I think we have, I'm just looking on the charts here of the events. Friday is obviously the employment situation. By the way, that Friday number, I'm super curious to see if the last number, which was that high number, is going to get revised down, because that's been the trend, right? We see these out of nowhere big up jobs numbers, and then in the subsequent like 2 or 3 jobs reports after that, it just comes down, down, down. So this is going to be, in my view, the key for the Fed if that number sticks and holds where it was, or if it's brought down and it was, again, one of these convenient reporting errors. On Wednesday, we're going to get the GDP report. I think that's going to be the key for growth. And then obviously on Thursday, we have PCE. So we have 2 things coming up against each other here. Really 3 huge things. The GDP report, which is our growth report, the inflation report right after that, and then the jobs number right after that. So it's sort of back to back to back reads of the economy. And I think that's going to be very key going forward here. That to me could set the pace for interest rates. So I do like the idea of, I don't want to say the shake and bake in TLT, because I don't know that that's a thing, but I think it's better maybe that rates are higher into that so that there's no upward surprise shock on that. And if it's anything, it could be like a sell the news, or in this instance, buy the news for TLT, because when bonds are going lower, obviously rates are going higher. There's that inverse relationship. One of the things that's also really concerned me is the lack of follow-through action on stocks that have good earnings numbers. They have responsive selling at the old highs. Let's just do JP Morgan, for example, right? On 8:30, they made a high at 225.48. And then post-earnings spike on 10/11, you've had now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days consolidating under that high. I do like that it's building pressure there and that the back off has been mild, but I don't think you'd love it so much if you were in calls. So another example of call spreads that are a little longer dated. So what would I have done here in this situation, how I would have traded this? So let's say I was in the November options for this example. I would probably take, if I was just in calls, I'd roll it out to December or January spreads. Or if I were in November and I wanted to stay in November, I would turn it into a spread here. Once I saw that we couldn't push up past the 225s. And this is also a bit of an issue, because that front month volatility is going to contract, right? So you benefit more if you go longer dated, but then you're sort of like locked into the play. And by the way, if we did channel high on JPM and we did it tomorrow, you'd be looking at 238s to 240s, depending on how long it took to get there. So trade accordingly. I think the market here just looks like it's consolidating. I don't love that we're below the Friday highs. That was an obvious sale too, with a big spike up like that into the open. It sort of seems like we have a Costanza situation when overnight inventory is long, and we had that again in the overnight session here. I don't know that it was as extreme, but there's always seemingly that rebalance, particularly when breadth is mild. I mean, if we opened up, 5, 6, 7 to 1, I don't know that I would count on much of a rollback. But if it's only 2 or 3 to 1 or even 1 to 1, usually there is that rollback. And the best sign that there will be a rollback is if breadth is mixed. That always, for me, is a tell and a cautionary situation. If there are any more questions, I'm getting ready to wrap soon, but we'll do a couple of more. Apple is another one that brushed up against the old high at 237.23, had a bit of a pullback, although I like that the 20 MA there held. I would probably raise stops there. I wouldn't let it get below 232.92 on me now. And the 10 MA is up there, but it's still got to clear, right? The 237.23, but it is, to me, just consolidating here, and it looks like it's building pressure, probably for the earnings report. That's also very important to me, how stocks act not only just on the earnings, but post-earnings. Like Netflix, for example, really hasn't been able to build on the gains, right? You had that 2 days up, and now it's just sort of stuck in the mud. I'm good with that. I like the consolidation, and I'm going to stay consistent there, that I think anything that stays over 736 to me is still bullish. But, if you're already long or you chased it up here, 744.26, probably a good stop there. But again, I think that these are all just sort of consolidating post numbers, and they're not building on those gains. One of the ones I think has some potential, I don't know that it's going to go, but if Google can clear and hold over these 169s, it seems to me the expectations for earnings are super weak. But if you wanted to play this sort of in the, I want to say the cheaper seats, at least initially, maybe play the Google META trade, where if Google is up on their numbers, usually Meta will go up on their numbers, and then vice versa, like Meta will report and they usually go down on their numbers. So there's like that inverted relationship with those two. They initially go the same way on the earnings and then the opposite. It's not always the case. I have seen earnings situations where they both go down and they both go up, but more often than not, in my experience, they do the Costanza trade. There's usually follow on that first day or two, although in this instance, I think they report the next day. So that would be a good opportunity for me to book those, to play that trade. Amazon, I mean, this to me looks like, again, it's consolidating at the old highs, 188.65 to 190.59. And it's sort of in a wedge within a wedge and within an up channel. It still looks all right to me, but I don't really see, again, we're not above the downtrend. So that to me, I would wait for that maybe and play it in the after hours if it's able to crack the 193s for the move up to the 199s to 200s. But I think if the move is down, I mean, you're probably coming back down to the 200 MA at 179.82, and then we'd see. That has been the trade. The better play actually has been a sustained move below the 200 MA, meaning a closing basis, can often lead to still lower. But once you're below the 200 MA and then trade back through it, that triggers the long. Now, we've seen this. I'm looking on the chart 8.2. It had follow on to the downside, although that didn't last very long. And then on 8.28 and then 9.6, you saw it trade and close through the 200 MA, but the next session or two took it back up over the 200 MA. So that to me would be the bigger trigger. Up here, if I were already long, I'd probably stick with it and make it into a spread. And at some point, I mean, you have to have some discipline here. You have that inverted hammer with Friday's range. So I would just use that Friday low as a stop, 187.53. And then I'd press the long if we probably got over the 190.45. And I'd probably raise my stop to today's low at 188.83. So I think that's probably the better play on Amazon. A lot of these, I feel like it's better to be second mouse, because let's say you get your move and a lot of these moves are sticking and they seemingly will have follow on to the upside, you're going to get that IV crush. And I don't know that you're not really getting outsized moves on many of these trades. A lot of them, with Netflix was an example of one that was a little bit larger than should have been. So in my experience, that if you're not bigger than the expected move, you're really not going to make as much as you think. NVIDIA, what would I use as a stop? I told you today I rolled down the calls from the 155s to 150s, so that was my hedge here. Why did I do that? Just because the market in general, the NASDAQ was stronger than NVIDIA, and I didn't really love that dynamic. And I was looking at some of the big cap names that were lagging, and I feel like it should be doing it quicker, and you're seeing some of the money flow bleed out here. I just use the 10 MA. That's been a good gauge for me, the 139.20. Any move or close below there in particular, I think you could get a liquidation break to the 20 MA at 133.83, and then that 131.26 to 130.05 is the real key, because that would be the yellow channel low. There is a channel here within a channel, and if that were to snap, I mean, you're looking at a much larger pullback. But right now, I'm just viewing it as this is consolidating, just like JP Morgan, at or above the highs. So yeah, you have some premium decay up here, and if you're long calls, just turn them into spreads. I would use maybe 155 or 150 as an upper strike. I mean, it's not that much of a gain there, but I don't know like how you're positioned in this. So that would be my take on it. As far as futures go, I was looking at the a couple of things I like. I like that ES is above the afternoon bounce, like the late day bounce high here at 58.60 quarter. So anything above there, I think, is sideways to higher. Below is sideways to lower. Qs, I don't love that they're not above the apples to apples equivalent, and they've been toiling with that a bit all day, or I should say in the afternoon, starting after, let's say, 11:30ish. It's got to get over 20,562, and then you've got, you know, that 20,66675 as some resistance up there. So it looks to me like they're trying to ride price a little bit lower here, and it seems like my guess is that people are waiting on the big cap tech names, because if you're not already in them, you're probably paring back your exposure a little bit ahead of the earnings, in the ones particularly that have been up a lot, right? Like the Metas, the Nvidias, the Netflixes. Although Nvidia doesn't report for a while, right? They're like at 11:20, so they're way out there on that scale. But they'll probably react to other earnings like let's see, Avago. That's out there even further. One of the trades that I've put on that I've been a little not so thrilled with is that Micron play, playing for the inverted head and shoulders. I don't think the trade's negated yet, but I may stop out of it if it can't hold the 20 MA at 105.62. We're kind of close. If we pressed on up through, let's say, 114.81, maybe even 112.91, 111.15, I'd be adding at those stages, because if it's bearish, it shouldn't be clearing those numbers. And I think the upside would be 120.83 and then 127.49, which was the 716 gap fill. But again, a lot of, Q's filled the 716 gap fill, but, some of these stocks haven't. So I don't love the relative weakness on that. Let's end on gold and Bitcoin. So gold still looks all right to me. It's way above the 10 MA. It's kind of been riding the channel higher. If you were to keep going, you're looking at 255.83. Again, gold usually ends in a bang, not in a whimper, and I would imagine the 20 MA at 247.55-ish is still a buy until it's not. And then the Bitcoin still looks good. We've been bulls on that, by the way, and I said as long as we hold in the future 66,233, it was fine. We are running into some resistance up here. This was actually the 11/10/21 old high at 69,355. The more recent and I think relevant reference high here was from 7/29 at 70,825. So between 70,825 and 72,495, I'd be trimming and trailing. And if you want to raise your stop, today's low looks great to me at 68,070. If you want to use the 10 MA at 67,728, that's fine as well. And I think the just sort of bleed back here to fill basically today we spent the whole day pulling back, trying to fill the gap from the Sunday night futures open, more dramatically in the Qs than in the ES. So that might be and what's interesting to me also, that which could be a right or right out buy, is that gap fill is right at the 200 MA 30 minute, probably by the time you get there. So that could be a thing. Currently, the 200 MA 30 minute is 20,460. So I think that could be a right or right out buy, at least for a bounce or a scalp. I don't love doing it late in the afternoon, but you could obviously do it and just have a stop in the futures in the after hours. Anyhow, I think we could wrap there. I'll trim out the beginning part of this where we talked about, the setup. I'll trim it, and then we'll post it to my YouTube channel, my Vimeo channel, and then you could always, if you came in late, just rewatch it here. I save it. Hopefully it saves. We had a little trouble the first time. All right, guys. Cheers.